Well, good morning, everyone, or good afternoon, depending on what part of the country you are joining us from. I'm here in Vancouver today, and my co-host, Simone Gaudreault, who's our chief economist, is coming to us. Simone, I believe, from Montreal today. Sometimes you're in Toronto, sometimes you're in Montreal, so never quite sure exactly where you are. Occasionally, we have the good fortune to have you here in Vancouver, but I think you're in Toronto, in Montreal today.
That's right, Laura. I'm in Montreal.
Okay, well, I can see, Simone, that our guests, our members are already introducing themselves. This is my favorite part of the webinar, as you know, is like when everybody's, we've got Calgary in the house, we've got Kelowna, we've got Barrie. I can see people are already using the chat. The chat function is a great function to let us know where you are, and also to talk to each other. And then if you have questions for Simone, who's our main presenter today, and we'll get to that in just a minute, please put those in the Q&A, and then we'll be able to follow those questions. So this is welcome, and if you're new to our webinar series, a special welcome to you. Let us know that too in the chat. We always love to know if we've got newbies joining us. And you'll see you've joined a great group of business owners who are our members from coast to coast to coast, and we're really proud of that. This is the series where we bring you the information that's really relevant and timely for your business, and we try to make it as approachable as possible. So please don't be shy about asking your questions if it's not approachable. This one is a little bit more, we're focused on economics and economic conditions. So Simone is going to walk us through the economic outlook. Some of the data comes from you, and I know Simone's going to say a big thank you to all of you for filling in the surveys, but it's incredibly timely, and it's incredible how accurate, Simone, right? Our members are about forecasting, and you guys are accurate, and you're way ahead of StatsCan. So we get the data about 3 months earlier than they do, because nobody knows better what's going on in businesses than business owners themselves. You have a very strong incentive, and that's why Bank of Canada pays attention to this data and leans in. Finance ministers do, and we want to make sure you have access to this data in a really timely way as well. So we've got the latest economic data for you. And a little bit of outlook and forecasting. Simone and I are both economists by training, and we'll be the first to tell you that if anyone has a crystal ball about what's going to happen in the economy, they'd be rich. So be very skeptical about forecasts. Having said that, caveat, we do a little bit of short term based on kind of common sense plus your data. So with that, Simone, I think I should have introduced myself. I'm Laura Jones, the Executive Vice President. Some of you know me well because you've been on many webinars, and that really is a fancy way of saying I wear a lot of different hats. Really thrilled to be joined by our chief economist, who's amazing. Simone, I'm going to hand things over to you. I'm going to pop up and down a little bit. Just you and I are both economists. We like to chat about these things anyway. I'll slow you down if you get a little too technical, and but please feel free to put in your questions, and we'll get right to the main content. And I'm sure you're gonna. This is interesting stuff, at least for economists. So hopefully we can make it interesting for everyone. So over to you, Simone.
Thank you, Laura. Very excited to be here with you today. Let's go right into it. I know you want to know what it is that we have for you today. Here's an overview. We're just going to start the webinar today with the latest small business data. What we mean by that is the state of the small business sector based on the responses that you've submitted to us through our surveys And then we're going to go into the current economic outlook, looking at, of course, the inflation situation. We also have a few interesting, we believe, slides to share about the labor market situation that might be useful to you. As a third sort of big bucket today, we wanted to spend a bit of time highlighting the key differences between the US and the Canadian economies and the current situation. A lot of people draw parallels, and to what extent is it appropriate, and to what extent should we take into account some fundamental differences between our economies, but also we'll go a bit into the banking systems. And finally, the economic forecasts that Laura just mentioned. So we're doing short-term estimates of where the economy is headed. We'll have something to say about that towards the end of this webinar. If we go to the next slide first, I wanted to, as Laura mentioned, I wanted to take some time to, first of all, explain, and as CFIB members, that's probably something that you are aware of. CFIB, from its beginnings, almost since for 50 years, basically, has centered its action around the input that you are giving us directly through your meeting with the DM, what we're hearing on on the phone when you call a business advisor, and of course our surveys. This is where most of the data that you're going to see in the current webinar is coming from. We're sending you those emails every month or so on asking you to fill out surveys on different topics. We have regular ones, we have special surveys, and they're really helping inform different issues that small business is facing. With your responses, we're able to provide policymakers with an accurate description of the current small business situation and the challenges that you have, and some policy recommendations. So for that, I would just wanted to say thank you for filling out your surveys. And I hope in the next few slides, as you see our data, you will see how your contribution plays out in all of this, how the data is being used by CFIB. Let's go into the first part of our webinar, our economic outlook. I wanted to start with a couple of images that I shared for those of you who were on the previous webinar back in December. That's how we described the situation in two images. We're at the end of a long tunnel, seeing the light only to come out of it, and facing a lot of uncertainty, right? Like that's something that we're hearing a lot from you, from different the business owners and economic commentators. Very hard to figure out where things are going. At least that was the overall picture about 3-4 months ago. If we go to the next slide, now I've chosen two new images to describe what's going on in the spring. Things are decelerating. Inflation's going down. We'll get to that in a few minutes. The economy is also slowing down. And at the same time, what you can see on the second image, we have a bit more certainty. We can still see a bit more what's ahead, but still at the last part of a long hill, right? Like, how are we gonna land this? And that's also some sort of a questioning that we have right now. Like, how is this thing going to land? There are still some bumps in the road, and how and what's on the other side of that hill that you see in front of us. So a bit more uncertainty, but still not entirely clear. Let's go to the next slide that I think starts to explain a bit more about what's going on with the small business sector, with what you are telling us through our surveys. This data is from February, and you can see that for a large share of businesses, the financial pressure is still quite there. You have 49% of CFIB members back in February that were still below normal revenues. So that's the the sum of the first three blue bars, if you prefer, and 61% that were below normal profits. So the first three yellow bars. That's still a significant share. You have a lot of businesses that are still not fully, still haven't fully recovered. And that is a message that we're trying to relay to policymakers as often as we can, explaining to them that we're not out of the woods yet. On files, for example, like CEBA, a lot of you have asked for some relief, maybe an extension of repayment deadlines. We've been active on that front, but we'll have more to say in the next few weeks as we have results from a different specific special survey on CEBA that we're going to be able to release. But for now, let's just focus on the financial situation. We have on the next slide two, I was going too fast. Here you have a slide that explains a bit more about what the 49% that are below normal sales are attributing those subpar sales to. And as you can see, you've told us that the main reason is that each customer is spending less on average, and that this inflation situation where prices had to be increased, and also the lack of customers. Those are really the three top reasons why revenues are subpar at the moment. And you have a few other reasons that were listed there. On the next slide, we can see how this translates into a pandemic debt that is a residual pandemic debt that is still there, that takes longer to get repaid, of course, with lower revenues, with this inflation situation that's driving up expenses. 57% of you, of CFIB members, reported in February that you were still holding some pandemic debt, and the average for Canada was $104,000, almost $105,000. So that's a significant outstanding debt level. And what's worrying a bit is that we haven't seen that level go significantly down in the last few surveys where we asked that question. We're actually asking the question every quarter or so every 3 months or so right now. So stay tuned. In May, we're about to send you a survey where we're going to ask you for an update on those numbers.
And Simone, this is more of an economic update than an advocacy update. But I am just going to take this moment to, because I know we get a lot of questions from members about, are we advocating to have the deadline on CEBA extended? And on the CEBA loans for that part of the pandemic debt. I know not all of the debt is in that loan, but yeah, the answer to that question is yes, we are. We were disappointed not to see that in the federal budget, but our informal motto at CFIB is we never give up and we never go away. So as long as you want us to be asking for that, don't worry, we will be. We take our direction from you, and we will be advocating on that. And my colleague, who many of you also are familiar with because she does a lot of webinars with me, is Corinne Pullman, who's in our Ottawa office, and she and her team are very active, have been very active on that file. So just in case there weren't any questions about this, but this is a concerning, picture that we're seeing with debt, lower revenues and higher costs causing lower profitability. And that's still the state of things kind of post as we're emerging from the pandemic. And back to you, Simone.
Thank you, Laura. So really, that's the current picture that you've reported. But if we look at your perspectives on what's ahead on the next slide, you will see that that is data from a survey that is called Your Business Outlook. And we take that data, it's a survey that we send to a share of the membership every month. 1/6 of the membership will receive this survey. So you will receive it on average twice a year. And that's the same question since 2009, basically. So it allows us to track different economic indicators, and we ask you about what are your business performance expectations for the next 3 months and for the next 12 months. So long term, the next 12 months, it's the blue line that you're seeing there, and short term, the next 3 to 4 months, that's the yellow line. As you can see, and the dotted lines is the historical average. The blue dotted line is historical average for long term, yellow dotted line historical average for short term. As you can see, we've been quite below expectations for normal expectations for most of the post-pandemic period. And confidence has been quite low, both on the long term and on the short term, according to our index measure here. We've reached as recently as the beginning of 2023 very low levels around the 50 mark. What that means is when you have an index level that is around 50, you have equal shares of businesses that are optimistic and pessimistic. Whenever that goes above 50, you have more that are optimistic. So here you can see that you have slightly more businesses in March, which was the last, we're about to release the data for April later this month. The last Thursday of the month is when we release the new data. I can tell you that the picture, it's not going to be a takeaway that's going to change that outlook. We're going to see some trends being confirmed. What you can see here is that both for the long-term and the short-term index, it's going back up a bit. So that's the end of the two lines. Optimism on the upside. So that's the piece of good news, but still has ways to go before we go back to normal territory.
Yeah, so the key takeaway here, Simone, I think, is that the optimism is below normal levels, below average levels, but is improving. So to go along with that, some of those pictures that you showed, I mean, the economy's not on fire, it's not roaring, but there is some more optimism in the picture, which is nice. And when you look at that real dip where you've got recession, that was COVID, obviously, and we had never seen levels this low on our. We've been doing this index for decades now, and we'd never seen levels that low. The last time they were low was 2008. You can see that at the beginning. There was a pretty big dip there. But nice to see that we're at least moving in the same direction, and that April confirms that.
Yeah. Good trend, still concerning levels, but going back up in the right direction. So that's a piece of good news. If we go on the next slide, the same survey asks you every month, or again, a share of you. You're not getting the survey 12 times a year. You're getting it on average twice a year. But we ask a share of the membership every month. You can see what are the main costs concerns at the moment. Fuel, energy costs, 65% of businesses saying they're being challenged by that at the moment. Wage costs, 63%. And then insurance costs. A lot of you are reaching out to mention that premiums have increased. Sometimes even having difficulty finding an insurer for some of your business operations. So that's the top factors here. The black dots for each line, they represent the historical average. So you can see that for most of them, it's higher than it used to be. Of course, in a high inflation world, we have a lot of cost pressures. You can also see, interestingly, where it is significantly higher than the historical average. So if you go into the middle of the chart for product input costs and borrowing costs, you have almost double the historical shares of businesses reporting that this is a difficulty. That's not surprising, of course. Product inputs, you are telling us that they cost a lot more to get, and the borrowing costs, that share has gone up, has doubled basically in a year, and that's of course due to the interest rate hikes by the Bank of Canada, but we'll come back to that in a few slides. If we go on the next one, It's a similar question, but that asks you about it's about the general challenges in running your business. And of course, as you can see here, it's the shortage of labor, whether it's skilled labor and now it's gone into unskilled, semi-skilled labor. It's very generalized, and you have very high shares of businesses that are saying that it's limiting their sales or their production growth. We'll have another set of data later on this webinar that is asking about the issue a bit differently, and you'll see like how many businesses are impacted at all, because sometimes maybe it hasn't limited your sales or production, but it came at a cost. So that's what we're going to see on a different slide later, but you can see here the other top issues. Still a shortage of input products for a large share of businesses. So supply chain issues seem to be still prevalent. On the next slide, we wanted to talk to you about the inflation situation. Of course, this is the big talk on the economic side of things. We picked that picture to show that perhaps the plane is in its final approach. It seems to be about to land, but as you can see, things are not entirely straight right now. Like there is still a bit of adjustment that needs to be done, so we can land this plane safely. But still, we're in the final approach. As we can see on the next few slides, the next slide actually, we have a couple of charts here that I've taken from the central bank, the Bank of Canada. They released their quarterly report on the state of the economy last week. And those couple of charts were interesting. I will ask you to just focus on the red lines for the moment. They are showing inflation. And on the left chart, what you're seeing there, it's the inflation that everybody talks about. It's the 12-month inflation. That's what the media, they report. StatsCan released their latest inflation number earlier, only a few days ago, and the headline is that it's gone down, but it's still significantly high, around the 4 or 5% mark. But actually, that's calculated when comparing the price index from March, was the last month they released the information from, between March of 2023 and March of 2022. And what happened actually with the inflation is it really started rising in late spring of 2022. So we still have a sort of a base effect where we compare to an index that was lower until last spring. So once we start reporting inflation on a 12-month basis in the next few months, you'll see just by statistical effect that the inflation is going to keep going down. And that's why the central bank governor has said that he's confident. He said that only a few days ago, that he's confident that inflation will be around 3% by the summer. And that's actually what you see on the right chart. It's inflation calculated a bit differently. We look at the price level from, again, the latest data available March 2023, and we compare it to 3 months before, and then we put it on an annual basis. And as you can see, when you look at inflation like this, we're much closer. We're actually at the black line, which is the central bank's target of 2% inflation. So it seems like the inflation situation is getting closer to a place where we can say it's more in line with a controlled situation.
Couple of points, Simone, I wanted to make based on some of the conversations you and I have had. First of all, you were predicting this back in December, because you were saying, look, the challenge with looking at inflation year over year is we've been comparing to a very low base, because in 2020, because we were still in the pandemic, 2021 in the spring. And so you've been comparing until recently, we've been comparing to a very low base. So it looked like prices jumped a lot, and they did year over year. But when we look at it 3 months by 3 months, we're seeing that the pace of that is slowing, and that's what you're showing on the right hand side. So there's some reason for optimism here. Of course, we worry about inflation because that's affecting interest rates and prices, and that having low stable prices tends to be good for economies overall, and having higher price increases isn't great. And we know the Bank of Canada is very serious about getting back into their band. But the other thing I wanted to that you and I have talked about that we should make sure the audience is aware of is that band for the Bank of Canada. 2% is the number that gets talked about a lot, but the actual band that they're shooting for is between 1% and 3%. And so we're now getting close to being within that band, which is another reason to be a little more optimistic that interest rates aren't going to continue to go up.
Absolutely. And the bank is also using, so you're right to point out that the 1% to 3% is the sort of the band that they're looking at. Their public message is very much around the 2%, and that's their ultimate target. But once you've reached the inside of that band, they're probably going to be a bit more confident that the situation is, or this inflation plane is landing properly.
So Laura was asking the question that I was trying to clarify, and just to make sure that we have clarified it, that difference between the 3-month and the 12-month. So 12 months is comparing to a year ago, how much of prices have increased. 3 months is comparing to looking over the past 3 months. So I don't know if you want to add some clarity to that too, Simone, and why those two numbers are so different right now.
So they're both actually showing annual inflation. Ultimately, the stat is annualized, but the way it's done on the left-hand side is just by comparing the latest month with 12 months before. So it's annualized automatically. With the right chart, we're calculating current inflation with 3 months ago, and that's giving us a pace. And then we put that, we annualize it. So we translate it into what that would mean at that pace for a 12-month inflation. And that gives you that chart that you have there. So the current pace seems to be much lower, in other words, if you look at that other measure, than what the classic measure of inflation is showing us. So it's a different.
That's because we had this very big jump.
Yes.
In once things started opening up, there was
Yes.
this big jump in, so prices were quite low and stable. In fact, even inflation was running lower than historical, I think, Simone, for much of the pandemic. And then when stuff started opening up, there was this combination of supply chain challenges, labor challenges, and everybody wanting to buy stuff all at once, that caused this big jump in prices. So every time we compare that big jump in prices to the years before, the months before that were pandemic months, it looks like this big jump. But now that we're at this higher level, when we're comparing to a month ago or 2 months ago, we're not seeing another big jump. That's kind of, I know for economists, this is kind of fun stuff, but it's actually, I think, important to understand, because what gets reported in the media is really the annualized. And so it still looks high, but there's a lot of reason for confidence that it's low. And I know you're going to talk a little bit more about some of the factors that feed inflation in a minute. So maybe we'll get onto that now.
Yeah, we'll get on to that. Actually, right now on the next slide, we can see that it's a different story depending on what side of the economy you look at. The previous slide was on aggregate for the entire economy. Here you have, again, two charts, and you have a few countries. Again, Canada, you may want to focus on Canada here with the red lines. You have the goods, the inflation for the goods, and inflation for services on the right side. Goods left, services right. You can see that the path of inflation for goods has been very different than the path for services. It has gone way higher for goods, but it has peaked in the past several months, and now it's going down at a healthy pace. So news are encouraging on that side of things. For services, it's a bit of a different story. It didn't go as high, but of course, we all know the story. During the pandemic, people bought more goods. They were constrained. They couldn't go into experiences, concerts, restaurants, and so on. And once the economy started opening up, they stopped buying the goods and they went into services spending. So that's what you're seeing here. It's the inflation for services has gone significantly up, and it has been on an upward trend for the past couple of years almost. And now we're sort of on a high plateau. You can see also that for services, the situation is slightly more under control for us in Canada, the red line, than in the US, for example, where it's still going slightly up for us. We're really more flat, and their inflation for services is much higher right now than for us. It's around the 7.5% mark, and for us it's around 5%. So that's really the next area where the Bank of Canada is going to focus its attention, and central banks across the world, as the supply chain issues get resolved. And on the goods side, it's getting better. There are still a lot of issues, of course, but as this is on a downward path, they focus now their attention on the services sector, which is, as you know, a very large share of our economy. The lion's share of our GDP, for example, is in the services sector. So that's why it's so concerning to the central bank and economists in general. So we're hoping to see this, in other words, this line, these lines on the right-hand chart go down. If we go to the next slide, that's the supply chain story that I was telling you about just a few moments ago. The story out there, what you're hearing in the news, is that globally, supply chains, the issues are getting resolved, that we're back to normal. The chart that you have on top, it's one of the most frequently mentioned economic indicators to measure supply chain issues across the world. It became, of course, famous in the past few years. It's the Global Supply Chain Pressure Index from the Federal Reserve Bank of New York. And as you can see, for them here, it's the normal, the average value is the black horizontal line. And they calculate here with this index how far from normal things are going. So if the line's going above, there's more pressure. And as you can see at the end of the line here on the right side of the top chart, it has now gone below the historical average. So from their perspective, supply chain issues globally are pretty much resolved. But we can see from the bottom chart that what you're telling us, that's data from our monthly survey, again, our business barometer. You still have 17% of small businesses in Canada that are reporting that a shortage of input products is limiting sales or production growth. That's more than double the historical average of 8%. And we're not entirely back to a normal situation, at least from the small business perspective in Canada. So it's one of those areas where the view from Main Street and from small business is actually different than what you hear in the news. This may be due to, I know, Laura, you and I, we had the discussion, and you were asking what could it be due to, and why is it resolved it seems to be resolved according to this indicator at the international level, and our members are reporting a different picture, painting a different picture. And I think you offered an interesting perspective on it.
Well, I was saying that our members are often at the very end of the supply chain, right, with maybe not with smaller containers or half a container or whatever it is, and that sometimes those challenges may not be worked out. We'd love to hear from all of you, but I was going to make a different point, Simone, which is this is why our data is so valuable. You know, the Bank of Canada governor leans in on stuff like this, because if they're just looking at the chart above, they're looking at the Bay Street view that this is resolved. And as Simone said, the Main Street view is sometimes different from the Bay Street view. And it's very important that you have a voice at the tables where decisions are being made, because if decisions are being made as if this is all resolved and there are still issues, that's not accurate. And there's all kinds of examples of that. But anyway, we should get on. I could talk about this all day, but we should get on because there's some other stuff we want to go through, especially on wages, which I think will be valuable for members. And I know you're not quite done with inflation yet.
Yeah, we'll just go to the next slide, which is I wanted to address this energy OPEC thing. As you know, like a couple of weeks ago, OPEC announced that they will cut oil production across the world, and that, of course, if you have a lower production level, that has an impact on energy prices, and energy is a big component of overall inflation. And some of you may have seen an increase in prices at the pump recently. When OPEC announced their decision 2 weeks ago, experts were saying it may take about 2 weeks to materialize. And plus, I think they're switching from summer formula to from winter formula for gas to summer formula, which is traditionally a bit more expensive. So there's always a bump up in prices at this time of the year. So you may have seen an increase in gas prices and wondering what this might do to inflation. Actually, what you can see here on the chart is the different components of inflation as measured by the Bank of Canada. That's from their report from a few days ago. And I believe they were able to integrate to a certain extent the OPEC decision to cut production. But energy here is the blue bars. And as you can see from the chart, they actually are not forecasting energy prices to increase inflation in the next few quarters. They're showing it to be a decreasing factor. So they believe that that's not where inflation is going to come mostly from in the next few quarters. You have it mostly coming from, of course, housing costs. That's what they describe as shelter. So that's the purple bar, of course, going up. There is an incredible increase in demand for housing at the moment in Canada, and we're just not building enough housing to meet demand. So that's for the long-term trend, but that's going to keep putting pressure on shelter housing inflation. And of course, in the short term, also you have the increase in interest rates that are increasing payments for Canadians at the moment on the housing side.
Simone, I was just thinking that might be a good moment to hit Claire's question, because she's talking about the news notes that interest rates have helped the housing market, but housing prices have gone up this year by quite a bit. And of course, there are a number of factors that you've just touched on, some of them that hit housing. Interest rates going up in theory would cause demand to go down for housing a little bit. But if that's swamped by other factors, then you can still see housing prices increase. So I don't know if you want to say any more about that, but I just wanted to hit Claire's question, because I'm sure a lot of people have that sort of scratching their head. Interest rates are going up and housing prices are still going up. What's going on?
That's puzzling, isn't it? But that's exactly what's going on. So you have the short-term situation. So the Bank of Canada is trying to slow down inflation, slow down the economy with a rise in interest rates. They're not going specifically after the housing market when they do that. Their aim is more global for the entire economy to slow down. But of course, an increase in the bank's interest rate is going to hit first and foremost the housing sector. So you may be thinking, okay, that's gonna discourage a lot of potential buyers. But you have to think that for the past, I will say, venture to say several decades, we have systematically built fewer housing units than what was needed in terms of population growth in the country. So that gap, that's building up every year. Like, we cannot catch up. Like, there is a huge backlog that is being created and that grows year after year because there is simply not enough housing to meet demand. And as we're gonna see in the next few slides, I wanted to discuss it in the next few slides, but actually I can share that the recent data is showing that we've increased the Canadian population by 1 million this past 12 months because of immigration, and we've had unprecedented levels of immigration. That's something that's nowhere near close to what we're seeing in other countries, and that's also, of course, helping on the labor side of things, filling some of those vacant positions. But those people need to be housed, so that's adding some pressure on the housing market. So unfortunately, we cannot say that housing costs are likely to go down in the short term. But that being said, of course, the rise in interest rates, and especially if the bank is willing to keep them relatively high for a long period of time, as people renew their mortgages, it's going to be tougher. And for potential new buyers, it's going to be tough to enter the market. That's an unfortunate.
Yeah, and Anna was also saying the construction industry experiencing the skilled labor shortage, which is also causing, I know from my own renovation, is causing prices to go up. But Claire was also saying that, can any government really promise building affordable housing? And Claire, I think this is usually policy. What's going on in the economy and policy is so much more complicated than what governments can promise. They love to promise affordable housing, and then housing prices continue to rise. There's a lot that is it's very complicated, and I don't think government, they can promise to build it, whether it stays affordable, especially if they're putting it at market rates. I mean, this gets into a whole interesting and complicated policy discussion around things like permitting timelines and why does it take so long to permit, and multiple levels of government involved in that. And then, as Anna was raising, construction costs are going up. So there's a lot of factors that go into that stew, which beyond what we're going to talk about in this webinar. But I wanted to just draw a link to this cartoon here on inflation. This is the cartoon which would have you believing that OPEC's announcement that they're reducing supply is going to fuel more inflation, but in fact, it may actually be just a response, as Simone is showing you, to the fact that energy prices have gone down. So OPEC is now trying to kind of shore something up here. And this isn't actually the reality we're expecting to see in the next 3 months.
Yeah.
Okay, I'm going to move us along, Simone, because I know you've got other really great stuff to hit.
Yeah, and just one last thing on the chart, because we've talked about housing, we've talked about services, goods, energy. I just wanted to very briefly touch on the food situation. We're all seeing it at the grocery store. That's the green bars in this chart. As you can see, the bank is still forecasting food inflation to be an important component of overall inflation for this year. Something to keep a close eye on, also on that side of things. Let's move to the next slide. I'll cover that very quickly because we've touched on pretty much all of those points. But what's the play ahead for the Bank of Canada in terms of interest rates? We've seen the steepest rate hikes in a very long time, and the bank and that has had impact on members. I've mentioned it previously. You've seen the chart. So business owners reporting borrowing costs are a challenge. It's doubled in 12 months, happening almost in lockstep with the interest rate hikes. So doubled to from 20 to 41%. The central bank is likely done raising rates unless We cannot go back to the 2% level in the next few quarters. But it's likely to keep rates relatively high, even if there is a rate cut before the end of this year, which a lot of economists are increasingly skeptical about. Unfortunately, even if there are rate cuts, they will not completely reverse. They will be relatively modest in terms of relative to the increase that we've seen in over the past 12 months. So before we go back to a situation where we can say interest rates are relatively low, it is going to take a little while. And we know that a lot of you, in a separate different survey from a few years ago, about 2/3 of business owners reported that they had some variable rates for their loans. We know that it's going to hit you, and if you need to borrow, renew this year or in the next few years, credit costs are likely to be a bit more expensive than they were in the past. And the US and Canadian central banks, they're likely to follow slightly different rate hike paths for the next few quarters. Let's move on to the next slides. It will get us into the why. We wanted to just highlight a few differences between the US and Canadian economies. Here you have a few key elements. Consumption in the United States rebounded more strongly and earlier than in Canada during the pandemic. They also have a currency that is a refuge currency when times are uncertain, like right now. It's sort of shields them from this inflation impact in a way. When you import goods, when your dollar is strong, you import goods, they're less expensive, relatively speaking. At the same time, their services inflation is higher, as we've seen on the previous chart, and on a slightly less encouraging trend. So their monetary policy is likely to be a bit more restrictive. So they're going to have higher interest rates in the short term. Usually you see like interest rates in Canada and the US being quite close to each other. But for the next few quarters, you can expect, unlike the Bank of Canada, you can expect the US Federal Reserve to keep raising interest rates. What's helping us in Canada, or what's shielding us from further interest rate hikes? We have higher immigration rates, as I've mentioned, like unprecedented levels of immigration, a stronger rebound in the labor force participation also in Canada. It's helped relieve some of the pressure in labor markets. And at the same time, the bank cannot go too high with interest rate hikes, because frankly, our housing sector is, relatively speaking, more important in Canada. People are just more, the housing market is red hot, as we've just discussed. The prices are very high. Households, unfortunately, are more leveraged. And the structure of the mortgage market is also a bit different in Canada. You have shorter terms, you have more people on their variable rates. So basically, Canada is a bit more sensitive to higher interest rates than the US. If we go on the next slide, I wanted to show you also, because in the past month, we've seen some turmoil on the banking side of things, some banks failing in the United States. That was very high profile in the media. And some people wondered at that moment whether or not that might be contagious, that it might infect the Canadian banking sector. Well, as you can see from this slide, the first thing that can be said is our banking sector is way different than the US banking sector. You have and you have about 28 domestic banks in Canada, more concentrated sector, and also 0 bank failures in the past almost 25 years compared to 562 in the US. again, like the mortgage market is quite different. Americans, they have longer terms for their mortgage, smaller down payments, fewer clients on variable rates. That is all impacting how the current inflation situation, interest rate situation is playing out here and south of the border. So again, reasons for being more confident that our domestic banking sector has a better shield against the current situation than what's going on in the U.S. On the next slide, I wanted to gradually take you into your perspectives on inflation and on wages and prices. So again, that's data from our business barometer, and that's what you've reported you were planning to do with prices and wages for your business for the next 12 months. Blue line is prices. As of this March, it has gone down to 3.5%. So on average, you say you plan to increase prices by 3.5% over the next 12 months. And for wages, it's 3.1%. Now you've seen the gap between the two lines build in the past few years. That's normal. Wages are a bit more sticky than prices, so they take a longer time to adjust. Of course, prices have since peaked. They've peaked last summer, and they are now going down. And wages are also going down, but reaching sort of a plateau there. How does this play out by province and sector? You can see it on the next slide. We wanted to offer you some perspective for your own province and your own sector. You might be interested in looking what businesses similar to yours are planning for the next 12 months. So you have it there in terms of the provinces where you have the biggest price plans, some of the Atlantic provinces and BC, and also for wages, Manitoba, Quebec, and PEI and New Brunswick. And on the sectoral side of things, hospitality, certainly like big price increases due to input costs, labor costs, of course, construction, as we've just discussed. I think some of our participants today highlighted it already. Like it's tough to find people and to find inputs. And on the wage plans, hospitality, again, one of the top sectors, and transportation, where you have a lot of labor issues right now. Let's go to the next slide. We'll go a bit more into the labor force before we move to the forecast. I need to move us along a bit faster. We're drawing to the end of this webinar. Just a few cartoons here for your enjoyment, describing the labor shortage situation, of course. Let's move to the next slide. We have here how the wage pressures have played out in the different sectors we compare the last available quarter with the last available pre-pandemic quarter. So Q1, first quarter of 2019, that's the yellow dots, and the first quarter of this year, that's the blue dots for each sector. So what they are representing is the share of businesses that are planning to increase by 6% or more. Why 6% or more? When we designed a survey back in 2009, we probably didn't think that wages could be increased in a single year by more than 6%. So we capped the answer choice there. But as you can see, some of the takeaways from this chart, that you can see, like for every single sector, the share of businesses impacted by high wage increases has increased.
Yeah, Chris was just making a comment on that in the chat. So Chris, this one is for you. Simone's hitting this, that 6% per more, and we never even used to have that on our scale. We had to change our question because of what was going on. And you can see it's just wild what's going on in hospitality, with 35% of members there planning a 6% or more increase. So the slide before was showing you kind of the averages, but the reason Simone wanted to show this slide is the average can mask some of that variability that's going on. And there are a number of you planning fairly big increases. And I think your next slide, I'm going to move us along myself here. I think your next slide kind of shows a similar thing. So Alexa, maybe you can move to the next slide there for Simone, because this is the same kind of, this is a slightly different breakout. But you can also see on this one, Simone, that some are planning no change. So you may be in that category where you're looking at high, you may be at the average, but about a fifth of our members are saying we're not changing anything right now. And you can see
and you have the green category where it's a slight increase, right? Like 27%. So it's roughly a half of all businesses that where we can say, okay, the wage situation is a bit more under control, but you have a good half of all businesses at the moment that are more under pressure. That's what we can see from the two blue areas of the chart.
And I know we have a few more slides to whiz through quickly, and you'll do that in a moment, Simone. But I just wanted to let our members know, I posted this in the chat too, but Simone's actively working on something that would be for members only, that would capture some of these data, because a lot of the big banks do this for kind of bigger organizations. But we know we suspect that it would be helpful for you to know what wage and price plans there are for businesses. So some of you have been responding. That would be super helpful. It's very helpful for us to know, like Simone will get a total pep in his step around this project he's working on. If you let us know that this is, I'm seeing a lot of more of this kind of information, Simone. So that's super helpful, real-time information for us. And now I'm going to let you whiz through those last slides.
Great. Let's move on to the next one, which is a bit more info on labor shortages. You have here, I said at the beginning of the webinar, we have a slightly different way of asking about labor shortages. Here, we're asking you if it has impacted you in any way. And as you can see, a lot of businesses, whether it's by province or by sector, are reporting that labor shortages are very acute right now. The private sector job vacancies that we calculated for this quarter are 6,058,000 or so. So that's jobs that have been vacant for more than 3 or 4 months because no suitable candidate could be found. So that's just to give you an order of magnitude. It's before the pandemic, we reached something like 400,000 or 450,000. We said it was unprecedented and historical, and it since has grown by more than 50%. So unfortunately, labor shortage situation, it's not going away. It has somewhat improved in recent quarters, like the vacancy rate has been more stable. So we'll keep a close eye on this, but this is driven by demographics. So obviously a huge area for us to keep a close watch on. We'll keep you informed. We have more research coming out very soon on labor shortages. Let's go to the next slide, the forecast. It's the last part. We're almost at time. Laura mentioned that if we had like a crystal ball, we will be rich. We wouldn't be economists. So let's take all of this with a grain of salt. But going to the next slide, we wanted to offer you some of our forecasts for real GDP and inflation. We provide forecasts for the short term only. We don't do long-term forecasting at CFIB. We believe we're accurate in the short term. In the longer term, that's a business that we leave to some other forecasters. It's, as you can see, it's not something that the Bank of Canada is doing, but we're forecasting 2.5% growth in the first quarter of this year and 1.2% in the second quarter. So still no recession in sight. You need 2 quarters of reduction to see a recession. That's what the private sector consensus is showing for later this year, but remains to be seen. At the moment, we don't forecast a recession, and inflation is going to keep going down, as we've said before. And that takes us to our last slide, which is the conclusion and key takeaways. Overall economic picture is showing encouraging sign. Economy slowing down. Confidence, small business confidence is rising. Inflation is easing. But there are many key challenges that remain for small business. I've explained why. Half are still under financial pressure with below normal sales profits or COVID deaths. The supply chain issues are not fully resolved. and the labor shortages are here to stay. But the outlook for 2023 is improving. So I think that's an important takeaway as well.
So I'll just make one quick comment on the labor shortages. Anita had made the comment that self-serve trend and hospitality sector, check-ins and all of that self-serve that we're starting to see is kind of looking like it's more prevalent. Absolutely it is. And it's one of the things that we saw on one of our surveys, actually, when we asked business owners how they're coping with labor shortages. There were a bunch of different strategies: increasing wages, automation, looking at hiring seniors. There were a bunch of different strategies. But what was interesting, Simone, to both of us, is that when we looked at which strategies have been most successful, it was automation that came out high on that list. So this is a trend that is here to stay as well. And we'll probably be doing some more work on that, maybe some survey questions for you on what's happening there with automation. What are the good, the bad, and the ugly with that? Because it's a very interesting topic. I want to thank everyone for joining us. Simone, you can see, is a passionate advocate. It's great to have a small business chief economist who sits there with the big business chief economist at the table and holds his own. And as you can see, he's very, very credible and a delight to work with. And we're going to make this a more regular thing. So we've got a spring update from Simone and a fall economic update for those of you who are interested in this kind of thing. Simone, I'll let you just say a quick last word, and then I'll wrap us up.
Just thank you to all of you again for filling out the surveys, for informing us, and so we can relay the information to policymakers, making sure people understand what's going on Main Street. You have our contact info on this slide. Don't hesitate to reach out, and I'll be seeing you on the next webinar.
Well, thank you. You're seeing a lot of thank yous there appearing in the chat. Simone, I want to thank you as well, but I also want to thank all of our members, and especially when you're filling out those surveys, I hope you're never wondering, like, what am I doing? Just rest assured, those results are not collecting dust on some shelf. They are getting in front of politicians. They are getting in front of the central bankers. They are getting in front of people who matter, and they are giving you a voice. And so I often wish you could be with us in those meetings, just to see how people lean in to the data and the comments. And we read all of the comments. Simone and your team, you read all of the comments, and you're frequently saying, well, members are saying this or members are saying that. So thank you very much for filling that in, because we had great information today, but that's not just us, that's our partnership with you. And so we really don't take that for granted. Thank you very much, and we will see you on the next webinar. I don't know that we have one scheduled yet, but we've got a couple that we're looking at doing for those of you who are regulars. So we'll just keep watching, and we'll, as soon as we've got something really relevant and approachable, we'll be back. Thanks, everyone. With that, we'll end the webinar.